Back in Australia, as we know, borrowers sweat on each decision made by the Reserve Bank on interest rates. But in the United States, it's a different story. There, home buyers can lock in a 30-year fixed loan at an interest rate just under 4%. It sounds too good to be true and has led some Australians to wonder whether a similar product could work here. Emily Stewart investigates.
Most Australian homeowners take a punt on the official cash rate, with more than 80% signing up to variable loans. That's in stark contrast to buyers in countries like the United States.
About 75% of all loans in the US are 30-year fixed-rate loans. And, around the world, it's mixed. In some countries like the US, Switzerland, Germany, Denmark, Japan, mortgages are fixed, but in many countries they're floating like they are in Australia.
However, since the global financial crisis, more and more Australians are turning to fixed mortgages.
The rates are actually really attractive. We're at historical lows when you compare fixed rates to variable rates. The second reason is there's uncertainty. Remember, banks are now moving more or less independently of the Reserve Bank.
The most popular fixed term is 3 years, and the longest fixed loan available is 15 years. So would a 30-year fixed loan product work in Australia?
I think there would be quite a demand for it. A lot of young households don't want to bear that long-term interest rate risk. They've got enough risk associated with their employment and with paying their mortgages off without having to worry about interest rates going up a lot.
In theory, if we got a very deep, long-term fixed interest market and the derivative or swap market off the back of that enabled hedging, then yes, it could work. But the reality is that we're a million miles away from that. We don't have a very deep fixed interest market. Our term debt is really restricted.
So why does it work in the US? Well, when employees retire, they draw pensions from their former companies. In other words, these companies carry long-term liabilities, and banks match these up with long-term assets like mortgages.
The bonds that are issued by Fannie Mae and Freddie Mac, they're the big government-backed securitisers. They have been used around the world as if they were sovereign bonds because they're backed by the US.
In Australia, Sam Wiley sees a role for the government in better aligning the retirement system with the mortgage market.
If the government insisted that retirees buy annuities, then the people who were selling those annuities would have to match their liabilities, the annuities they've sold, with assets, so they'd have to buy long-term bonds to make the annuities work.
Even if the long-term product was possible, the Bendigo Bank's Mike Hurst warns Australians shouldn't expect such low rates as in the US.
There's actually a 4% spread between the official cash rate or the overnight rate and the 30-year bond rate. So if you put that in place in Australia with a cash rate of 3.75, then you're looking at a 8% base rate before you even put the credit in. So the rate might come in at, say, 10%. Or probably higher, 12%, which is going to be much higher than the standard variable rate.
So for now, no doubt Australians will continue to watch every move by the RBA with interest.